Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about underwater homes, purchase apps, and inventory. Logan, welcome back to the podcast.
It is wonderful to be here. And, I'm thinking of one of the subjects that we're talking about today about, purchase applications and how to read it correctly. And I was thinking, God, we've been doing this together for almost 4 years now.
Isn't that
right?
crazy? Yeah.
Isn't that crazy? I mean, you're doing the Lord's work. You're trying to rein me in. You're trying to keep me in line. You got to go on tour with me. I mean, how has it been the last 4 years dealing with this hurricane?
It's a full-time job. It really is. All the other things I do as editor-in-chief, just no, this is great. And we've been doing the podcast you've been doing the podcast for 2 years ago, 2.5 years
ago.
Yeah. Yeah. Great time. Wonderful. Well, I wanted to start today on a topic that I saw come across from Bloomberg, which Yahoo Finance picked up, which is headlined, "Seriously Underwater Home Mortgages Tick Up Across the U.S." So obviously that's a clickbait headline to try to get people to be like, oh, seriously underwater. So, the actual number of homes is pretty small, but I wanted to talk to you about the whole idea of underwater homes and what that means really to the housing market, because to me, there's not a huge story here unless they need to sell. So let's start at the top. How many homes did they say were underwater?
2,500?
Yeah,
I think it was
something like that.
2,500, right? It's one of the things with underwater mortgages, which was a staple of the housing bubble crash. It is always a net negative in to me every manner you could think of, because it puts a home owner at risk if they lose their job. But it also negates the ability to sell and move and buy another home when you're underwater, or you have to bring in cash for it. I think what people don't realize is that if you actually look at the underwater percentages going back the last 10 years, there's always a little percentage of people with loan to values over 110 or 125 LTV. And the percentage never moves. It's literally there all the time. And then there is the bulk of the homeowners in America. Of course, 40% of homes in America don't have a mortgage. And then the loan to value in the general sense is the lowest levels ever in history. So there's a lot of nested equities. Now, what you do have is that there are cities out there in America where Austin or Boise or somewhere in those, where if you bought at the peak of 2022, you're underwater, right? So in that sense, those homeowners, not like a mortgage rate lockdown, Sarah Wheeler, but a selling equity is an issue. And then there's always if you are underwater, don't have selling equity. Selling equity is just the equity needed to sell your house and have transaction costs paid for. And then in that context, you are foreclosure risk or a short sale risk. So it's out there. The percentages on the national levels are very small, just because majority of the homeowners in America have a lot of equity. Some don't even have a mortgage, and home prices escalated kind of out of control. And there are pocket cities where if you did buy in the peak, you're underwater, and there's loans that have a lot of debts added onto the balance. So their loan to value is very high. But in general sense, it's not a big issue currently.
So just to clarify, I think the 2,500 homes was in one, or 25,000 homes was in one area, but they don't really give the overall number, but they say 2.7% of homes have loans where they're underwater, and that is up from 2.6% of loans. So no matter what, this is a very small percentage if you think about it.
Yeah, I mean, less than 3% is, it's kind of like, for foreclosure data, there's always 1 to 3% of loans kind of in the foreclosure process. So there's always a shift percentage. But to me, what I've always talked about with credit risk is what I call late cycle lending. Late cycle lending is when somebody buys a home at the end of an economic expansion with little or no money down. And then immediately the job loss recession starts. And if they don't have selling equity, even if home prices didn't go anywhere, if they can't sell their homes, they're at a short sale or foreclosure risk. The late cycle lending is traditional housing risk work. The housing bubble crash was something else where you literally had people filing for foreclosures and bankruptcies like before the job loss recession started. So it's always going to be an economic cycle. This is one of the reasons why we wrote that article, I think in 2022, where I don't think there should be 100% financing, that neighborhood loan program that some of the banks were giving. Because if the Federal Reserve was talking about we need to attack the labor market, traditional credit bank tightening, you don't want that situation to be there. So in scale terms, it's really not. I've always tried to say this, post 2012, really renters are more at risk than homeowners. So when you look at like eviction percentages out there, it's already a lot higher than it is for homeowners. So I think when the next job loss recession comes, it's the same principle as always. Because of qualified mortgage, renters are going to be disproportionately at risk. And when you see the credit card delinquency data, it's a lot of younger households that are renters that even started off with not very good FICO scores anyway. So catchy headline, but in scale terms, nothing abnormal about what's going on that side.
Yeah, I thought so too. Catchy headline. And also outside of just the scale, if you are one of those people in Austin or Boise, as long as you have a job, I mean, it doesn't really matter if you're underwater unless you were going to tap out equity or unless you have to move.
Yeah, it's just in general terms, being underwater is never a good thing. But if you are under a qualified mortgage protected loan, you really could just make the payments and like first world problems. You're living in Austin and you're doing well. Again, if you lose your job, it becomes a structural issue. This is why late cycle lending risk is, this is the whole, creating economic recession models and trying to incorporate credit risks in housing and trying to get that. And jobless claims data is very key, or the labor market's getting softer. So you have to incorporate that credit risk with economic labor risk, and you put them together. Underwater mortgage is never a good thing, never a positive. But it's not the same thing as we saw, like the run up in credit in 2002 to 2005, and then the 4 years of foreclosures and bankruptcies before the job loss recession of 2008, and then the incumbent 4 years of having 250 to 400,000 new listings per week come happening, because those are, again, sellers that cannot be buyers. Now, in theory, a underwater mortgage person can buy another home if they sell their house and bring money to close with the lender. One of the running jokes I used to tell people, like, people said like home prices are going to fall like 30 or 40%. Homes can't sell that fast, especially if you're underwater, because you actually have to negotiate with the bank, or it has to be a foreclosure process or a short sale process, which minimum 9 to 18 months, in some cases takes 2 to 3 years. So the velocity of credit here in housing isn't like the stock market, where if you get a margin call at 12 o'clock, they're liquefying you in seconds. Right. So it's a much, much different marketplace. But I always tell people, you always keep an eye on the underwater sectors or cities in America, because where the job loss recession, there is your potential short sale or foreclosure risk.
Yeah, thanks for clarifying that. Okay, so I'm going to ask you this question. Don't go down a rabbit hole. We just need a very short answer. But when you say,
whoa. You can't do that with me now.
Oh,
no,
yes, I
are
can.
You kidding? Who do you try that on? Really? This is me you're talking to.
I know, and I'm doing this for the sake of our listeners, because it's a little bit of a tangent, but I just want to understand, when you say late cycle lending, how do we know we're late in the cycle?
Well, late cycle lending actually is, for example, let's just do a hypothetical here. Let's say jobless claims in the next 6 months goes above 323,000. Okay, so because the labor market, the internal of the labor markets are breaking, the period of the last 6 to 12 months would be technically a late cycle lending, right? Like, for example, somebody well-known said the U.S. economy went into a recession in October of 2023. Okay, if that's the case, then from October 2023, we have basically a recession happening. And I would say the 6 months before that, you would categorize that as late cycle lending, like giving loans to people. And then if there's a job loss recession, there's a higher percentage risk of that person losing a job versus, an economy expanding. Now, always remember, every week people lose their jobs. Every month people lose their jobs. People file for jobless claims. It's over 200,000. So we have a lot of fires each month, but the hires have override them, and this is why you have a job expansion. But you always have people losing their jobs. It's when that percentage increases and the demand of the economy is so weak that you don't need that kind of labor until the economy starts to pick up again. So that's when I talk about late cycle lending. That's a very, very critical part of my economic work and my housing work. We're just not there yet with jobless claims.
Well, also, it sounds like you won't know you were in late cycle lending until something happens. It's sort of a backward-looking metric, right? Where it's like,
yeah, I mean, you just have to take the jobless claims data, and once it starts to increase on a noticeable percentage, then you just assume there's a higher percentage of late cycle lending when a bunch of recession flags come off, but you really won't know until the jobless claims data breaks. So again, 2022 was a great example. I mean, really, Sarah, 2022 is like a historical year in so many things. I mean, crazier than even COVID. I mean, there's a lot of things that were happening that year that if we had to write one year this century, man, 2022 would be it. And there was a lot of recession red flags going. So in theory, even for myself, like I would not be issuing 100% financing on neighborhood loans if I thought that there was a higher risk of a job loss recessions. Naturally you want to retrace the highest credit products out there. But in this case, the economy is still expanding, job openings haven't broken, or jobless claims haven't. The labor market's getting softer, right? All these labor data are getting softer, but they're just not breaking because inherently every week somebody loses a job. So there's a homeowner right now that just lost his job. Does he have enough severance to last him another 6 months? Yes, probably in some cases. Does the dual household income have enough to make the payments? There's all these variables that you just don't know until you see the actual credit profile getting weaker.
Okay, great. And succinct. Nice job. You did it.
Oh, that was not quick, Sarah. So
it was quick.
We don't know. We don't do that. We don't go quick here. We got to explain it. It's got to be slow. We got to get, let everyone understand what's going on. We don't do little quick answers. That's for rookie. That's rookie ball. Come on, Wheeler. You know better than that.
Okay. Okay. We're going to talk next about purchase apps, which, where are we with that? What's the effect of mortgage rates? What are we seeing?
Now, one of our early conversations when you and I first met, and I talked about, purchase apps is one of these funky data lines. It's a trend survey, and it should be always looked at as a really efficient trend survey, but the percentages can be really, really awkward at times. So what happened this last week, and the reason I'm talking about this is Mike and myself are Altos data. The pending contracts are actually showing year-over-year growth, like every week, pretty much. So the purchase application data has been negative year-over-year for like 2.5 years right now, or it's been negative for a really long time. So what happened this last week is purchase application data was positive week to week, but it was down 17% year-over-year. So people are saying, "Oh my God, home sales are going to go down to 3.2, 3.3 million. Purchase apps are negative." And I said, no, we're pretty much kind of just hanging around here in the 4 million. So my best advice to everyone is we are at record low home sales for the third year now, but we have not been able to really break under 4 million and sustainably go down, even though purchase application data has necessarily been negative year over year for a very long time now. So take the year-over-year percentages with kind of like a grain of salt and focus on the week-to-week data. So the reason I say this is that in the previous expansion, I did the opposite. I never focused on the week-to-week data. I only focused on the year-over-year data because it was a very stable marketplace. Like if people saw purchase application data rise, up until like May, and after May, total volumes fall, and then you could get a good trend data by the year-over-year data. Here, all hell is broken loose with this data line. So how I look at it is when we do the tracker article, I take an inflection point. So at the end of 2022 and the end of 2023, it was November, right? So that's both the times where mortgage rates started to fall. One's from 7.25% to 6%, and one's from 8% down to 6.63%. So purchase application data, the forward-looking data in scale terms, is positive still from November. So if you look at the week-to-week data, and it's still positive in that sense. Now, what happened toward the end of last year is that when mortgage rates started to go to 8%, we started to see more weekly negative data. It took sales, down to 3.85 million. And then November came again and rates fell. And then we had about 8 weeks of positive data. So kind of focus on the week to week. Don't put all your eggs into the year-over-year stuff, because if people are starting to get confused, like, why aren't home sales crashing if we're constantly negative? We're not going anywhere with existing home sales. Now, remember this, cash buyers are still like 1/3 of all, and they're not going to get caught in the purchase application data. So you're running with, 65, 70% of the home buyers or mortgages. If the week-to-week data is still kind of trending positive since November, not much is happening. Now, when you get real growth, this data line looks like it did like at the end of 2022 to going into 2023. We had 12 positive weeks. Because we're working from such a low bar, it doesn't take much, but you move the needle. We should be rising year over year. We haven't quite had that marketplace yet because rates haven't gone low enough. If we had mortgage rates at 6% and you just stay there for like 12 to 18 months, you can get a growth profile. But it hasn't. Every time rates go down, they go back up again, and then they come down a little bit. So we're just back and forth, back and forth, back and forth. And the data is kind of back and forth. We have these, a couple of positive prints, and then we have some negative prints. So we're just working off of that. And rates have come back down a little bit. And again, the spreads. Sarah Wheeler, the positive story this year is mortgage spreads are getting better. It's not back to normal. I mean, we're probably, 75 basis points to 1% above normal out there. But the fact that we have not had a banking crisis like we did last year and send the spreads higher, like a good example, when I talk about the tracker article, I say, if the spreads were using the peak of 2023 data, mortgage rates are 0.5% higher today than what they were. That's the difference about how bad spreads have got. It's 0.5% better now on a normal spread curve. So that's meaningful. Like, with rates up here, could you imagine what would happen if the spreads got better and then the 10-year yield fell with it? That's that double whammy effect that, to me, it's the Fed pivoting and cutting rates or stuff like that has to happen for that to occur. But I would have to say one of the things I got wrong this year is that the spreads are actually acting better before the Fed is kind of getting into that pivoting stance. So that's a positive. People might not recognize it right away because they see rates still above 7%. But let me tell you, it could be a lot worse today if we had the spread data last year.
That is a great point. And I think you make that point every time you write about this. Every time we do the tracker, you're like, listen, spreads are one of the positive stories. And then when you update the Mortgage Rate Center, which we do every day with a comment from you, it always factors into what you're saying. Hey, watch this for today.
Yeah, one of these days, on the days where you don't see a lot of movement on the 10-year yield, those days the spreads could actually matter. Like a good example is that yesterday's pricing, the 10-year yield had gone up, but rates didn't do much. The spreads weren't that bad. So traditionally, again, slow dance, right? Wherever the 10-year yield goes, mortgage rates go with it, right? That's slow dance since 1971. But on day when you have such a wide spread, the potential of rates acting better is there. And again, I always people ask me about the spreads, and I'll give them the chart going back to the 1970s. And you guys can all see there's historical periods of times where the spreads get really bad and then they get better. They get really bad and then they get better. Here, they've been bad for a long time and they haven't really gotten better, but they're improving, right? So I think when you actually see a Fed pivot and rate cuts, stuff like that, then you can get better spread data. Historically, a lot of times when the recession starts, the spreads get really bad, but we're working from a terrible area already, right? So again, policy choice, right? Remember when Neil Kashkari said 6% mortgage rates is a problem? Oh God, people are going to have sex and buy homes, and I can't, that's going to make my life difficult. We can't balance out the economy if people are buying stuff. So we'll cross that bridge when we get there if they're going to be big crybabies about that. But that's kind of one of the reasons why I haven't been a Fed pivot person. They're literally telling us that, they're all panicky. Like Bostic of the Atlantic Fed said, oh my God, if we cut rates a quarter, we might unleash massive business investment. Boo-hoo! Oh my God, business investment. Oh my God, production. So the reason we say this is that the production of apartments, right? The permits are down. So when people think business investment, that's like one of the things is that you're seeing an absolute collapse on permits going out in the future. So eventually, if some people talk about higher rates are inflationary, they're really talking about that. Like down the line, we won't be able to produce enough apartments, something like that, 2 years going out. So it's stuff like that when the Federal Reserve talks at their meetings in Palisade. We understand that business investment is getting impacted. Really, a quarter cut's going to like unleash a massive business investment, and we're all going to. Such a little baby sometimes. Some of the things they say.
Didn't Neil Kashkari say something this week that you took umbrage at? I can't remember what it was.
Oh yeah, he said something that the basically the housing market is resilient. And I was like, homie, this is the third calendar year of the lowest home sales ever. And then your permits are already at a recession level and they're heading toward 2009 great recessions. And you're like, resilient? It's like, so again, Neil was part of the 2008 TARP people, right? For when he was working at Goldman Sachs. But what was the difference back then? When home sales crashed back then, everyone's like, oh my God, we have to help the housing market here. You don't hear that. Why? Because what we talked about last time, the credit markets are different. Qualified mortgage changed a lot of things because everybody's intact, right? It was designed to protect the American citizens against the Federal Reserve, against the job loss, against inflation, stuff like that. And you can see it right here. There's that nice shield, and it's been tested by many events recently, and it's passed with flying colors. That was the whole forbearance crash bros thing. Remember that? Remember how much fun we had with the forbearance crash bros? A bunch of professional grifting guys, like frat boys, running around opening their mouth. Now, remember that? What was it? Clubhouse.
Oh yes.
Oh my God, Clubhouse. Holy trash. Oh, I mean, I couldn't even do that anymore. Like I had to delete that. You had some crazy forbearance, like lying going on there about how it was like going to go to 15 to 25 million. You people are crazy. Let me tell you, all of you that are doing this doom porn stuff, like don't make the lie so big that it sounds absurd. Like, you don't want to be labeled that person. Like, I see these guys, these older guys are like 10 or 12 years older, and they're like been doom porning for so long. It's sad. It's pathetic. You like look at him and like, what's your life, dude? Seriously. So make the lies a little bit more believable. Like there were like 15 to 25 million loans going into forbearance. Forbearance was done by October of 2020. Why, Sarah? Because we believe in reading. And the labor data said that people that made over $60,000 actually got their jobs back, which means majority of homeowners, and that it was going to be a whole process of getting forbearance off because it takes a while, but it was pretty much everyone was good then. We're like, oh, it's going to be 10 million, 15 million. It's like, oh, we're like, I don't know. It's like under 100,000 now. It's like 0.2% of the loans out there. So that was a terrible grift, but it was fun for us. We made it fun.
You reminded me of Clubhouse. Back in the day, I think it was Thursday night in the pandemic, HousingWire would have like a 2-hour Clubhouse. And Brenna and I were in charge of it sometimes. Clayton did it for a while. Then he's like, you guys need to do it. And then we invited you up to the stage. And Logan Mohtashami, you saved our bacon every time because you can talk. People may not know this. You can talk for like 3 hours, 4 hours straight. Still say pretty interesting things and keep the whole room.
That's what I said. You told you. This is why I got mad at you when you said, let's do something short and tangent. Like, I don't do that. I go for the long game. I want to make everyone enjoy the process, right? And we don't do something quick just to get it done. We want to explain everything, right? Right. So yeah, I could go 2, 3, 4. Like literally, I think if you gave me the floor for 12 hours, I could talk for 12 hours straight. I probably need some water because my voice gets bad at times, but But I'm the Energizer Bunny. I go 24/7.
So this is the thing. If we have people in Congress listening to this, call Logan when you want to do a filibuster. He'll stand up there. He'll talk the whole time.
Yeah, I'll go off. I'll just list. I'll talk about every single year the American Bears gave us stupid recession theory and name every single one of why it was wrong. And we could go out because remember, our thing is all American Bears have failed since 1790. It is a clan. It is a demagoguery clan that will be buried in this country deep, deep, deep down with all their brothers and sisters since 1790. And we are going to win this 24/7 all the time.
Okay, well, for the sake of our listeners who are listening to this in 20 to 30-minute segments, we will conclude now with inventory. What do you think inventory? We've talked about home prices. We've talked about mortgage rates. What do you think?
All right, so it's going to be interesting. I was all happy. I had 2 weeks, back-to-back weeks of inventory hitting my number with higher rates. And I was like, okay, well, oh boy, that last week, maybe Cinco de Mayo, May the 4th, the Jedi Knights came in and said nobody's listing their homes for this part, but we should be back up to 11 to 17,000, but I'll have to see. Last week, we always have choppy weeks where inventory growth falls back down and then it comes back in, but mortgage rates have fallen down a little bit, purchase apps are. So it gets a little bit more interesting for me. But again, the reason I want 11 to 17,000, because to me, that looks to be normal, right? That would be normal inventory growth with mortgage rates above 7.25. So we didn't get that last year when rates went to 8%, but last year new listings data was trending at the lowest levels ever in history. Okay, so that can kind of be explained. Now new listings data is up. Now I always talk about, I really want the new listings data to be a little bit higher. So for those who don't understand why, normally we're about kind of 10 to 30,000 new listings higher than what we had, or that's what it was pre-COVID. From 2013 to 2019, that peak seasonal is kind of like 80 to 110,000, right? We've been tapping out around a 90. So when I talk about I want to see new listings data grow a little bit more, I'm talking about that regard to get us back to pre-COVID levels. Of course, nothing's like what we saw in 2008 to 2012. That was 250 to 400,000 per week. Those weekend things I do, right? Just to show people perspective. One of the reasons why I know it's people don't know it's not housing 2008 is because they never read the data back then because they don't have access to it. But we literally were running at 250 to 400,000. Like the peak seasonal data was running at per week. Yeah, this peak seasonal data was running at 375 to 400,000 per week. Now we have a hard time getting above 90. I just want everybody to comprehend that. So the crazy people that keep on saying 2008, we were running at peak 370 to 400,000 per week, and we have a hard time getting above 90K. And you're going to tell me it's 2008? Really? Boy, somebody needs to keep their mouth. Zip it. But so I'm hoping we get back on track on the inventory growth. Remember, I just kind of want a buffer because remember, third calendar year of lowest home sales ever. What if rates actually fell and stayed lower? I want a buffer for that, right? I just want something to buffer that out so we don't, have another savagely unhealthy housing market. So that's why I'm a very pro supply. Hopefully by now in 2024, people, you all can understand what I've been trying to say for the last 10 years. Economic cycles have run differently because credit markets are running differently. So we don't have to have these panic attacks about everyone rushing to the market to sell their homes and live on the streets. We don't do that anymore.
A very different market. Okay. We are great episode, Logan. Thank you so much. And we will.
And it's great because I didn't do a tangent. I didn't go short. You got to do the long game, Wheeler. Come on, you got to join forces with me.
No, I'm here to rein you in. Remember, that's what you always say, that I'm like the sheriff giving you the making sure you do it. So got to keep it short enough so people who are listening to us when they're working out or walking.
How did that work for Billy the Kid? Did they rein William Bonney? Yoo-hoo, I'll make you famous. No. You're going to rein Billy the Kid down. You're not reining Logan Mohtashami down.
Okay, didn't Billy the Kid end up getting shot and killed? I mean, that's not a good analogy.
There's a theory that Billy the Kid did not die. That whole death was not official. So William H. Bonney might have died an old man. Young Guns too, by the way, great movie. Young Guns itself. Oh my God. We got to go watch that. That's something we should. Did you ever watch Young Guns too?
I did. Is that a 90s movie, right?
Yeah, that's a 90s movie. Emilio Estevez.
Emilio Estevez.
Keith Sutherland. Diamond
sure.
Phillips. Otse, the horse. What do you say? Stop. So, okay, we're going on 90s tangents here. All right, I'll stop with that.
There's a tangent there. Thank you for being on. We will talk to you soon.